Hey guys, welcome to my mini lesson about going short in the stock market. So what does it mean to go short in the stock market? It is when a trader believes that a stock's price will go down. So instead of buying low and selling high, short sellers aim to sell high first and then buy low later to profit off of that drop. So how does this work? This can be confusing, but just try to follow along and it will make sense. So how does it work? First, you borrow shares of stock from a broker. Then you immediately sell them at the current market price. You wait for the price to fall because you believe the stock price is going to go down. Then you buy back at a lower price. So you repurchase or cover the shares that you borrowed at a lower price. So now you can return those shares, those borrowed shares, to the broker. When you return the borrowed shares to the broker, you get to keep the difference as profit. I'm going to have all of these notes that are on the screen right now in the description so you can study that. So an example, you want to short 100 shares of XYZ stock at $50 per share. The price drops to 40. Great, this is going the way you thought. Price is dropping. You buy back on those same 100 shares for $4,000. So you originally sold those borrowed shares for $5,000. You were correct. Price dropped. Now you can buy them for a lower price, return the shares back to the broker, and there is a $1,000 profit. Nice. Your short worked. Okay, there are fees and interest involved here, just as a little quick side note, but we won't get into that. There are risks of short selling. So there is an unlimited loss potential. If your stock price rises instead of falling, if it goes against what you thought was going to happen, you'll still have to buy it back at a higher price, potentially much higher, so you can return it to the broker. You will need a margin account to short sell. So there are also borrowed costs. You pay fees to the broker to borrow those shares in the first place. And there's also something called short squeezes. So if many short sellers all try to exit at once, meaning a bunch of short sellers are now buying at the same time, this can drive the price up rapidly. So why would you go short? Big picture, you're going to go short because you think that the price is going to go down. You want to profit from falling prices. You can go short as a hedge against long positions, or based on analysis, or for whatever, tons of different reasons that you as a trader may think that the stock's going to go down. You know, there can be weakness in the company or in the market. There can be 5,000 other reasons that traders find or think or believe that price is going to go down. So why do they go short? It's a variety of reasons, but big picture, they think price is going to go down. Okay, so a summary. Going short means selling a stock you don't own, planning to buy it back at a lower price and profiting off the decline. It carries a higher risk and requires solid timing and risk management. You are not selling something you owned. You borrowed it. So you're gonna have to give it back. Okay, hopefully this video about going short was helpful. Thank you.